much for coming. I so appreciate everybody taking time out of their very busy weeks, especially in the summer, to make it here every month. I'm always blown away by our turnout. So thank you guys so much for coming. We have such an awesome presentation today. I'm so excited for it. But before that, we're gonna go around the room. It's always good to know who's in the room. So when it's your turn, everybody's gonna stand up, say your name, what your focus is in real estate, and if you need help with anything or if you need a connection, I would love to try to help connect the dots wherever I can. So I'll start. I'm Maura McGraw. I am an investor and investor-focused agent in Alabama. I work in Birmingham, Mobile, and Baldwin County, and I flip and focus on rent-to-own. So then I'll let Candace go next.
Well, you'll hear more from me in a second, so I'll keep it short, but I'm Candace Pilgrim of Astra Equity, and my focus is multifamily.
I'm Brian Griggers with Anchor Title Company, and we've got offices in Gulf Shores, Orange Beach, Daphne, Mobile, and we do wholesale. So if anybody's got any title needs, I'd love to talk to you or help you out.
Robert Nelson, live here in Fairhope with Trinity Capital Ventures. I'm in the private money space. So I'm a certified private money lender.
Tom Gallagher, Fairhope Mortgage. I fund deals with DSCR loans, anything from $50,000 to $3.5 million.
And Tom is our sponsor and the reason that we have our wonderful Chick-fil-A lunch today.
Thank you, Tom.
So thank you.
Hi, I'm Eric Oden with Shop House Properties, creating great spaces for great local businesses. Our focus is commercial with strip malls and apartments.
Praveen, Sunrise Realty. So we are into flipping houses. I personally have some rentals also. That's about it.
Michael Maxey, I'm with Revitalize Realty. We are a property management company focused on long-term single-family residential. We have over 300 doors between here and Mobile, and we're really trying to expand our footprint over here in Baldwin County. We are also, and we do all that for $129 a month, by the way. We are also a licensed home builder, so if you buy a distressed property and you just want to streamline the whole thing, we will go in, we won't over rehab and get it to rent ready status. I'm looking to connect with anybody that has investment properties that they want to do long-term management with.
I'm Jill Callahan, and I'm from Pensacola, coming over from over there. And my husband and I, we flip houses over in Escambia in Santa Rosa County. And we actually have 3 currently that are going to be leased to owns that I'm working on right now as well. And we also do cabinets for flips and for our local flipper friends and the likes in our areas too, to help beat those big box stores.
Jack Jones, I was a retired firefighter, career firefighter in the Atlanta metro area. Built some spec houses east of Atlanta, counties east of Atlanta, and did a lot of flipping after the home stuff. So just looking for some more investments.
I'm Dana Lee. I'm really nobody, but I am like to keep my ears open for any investment opportunities. Thank you.
I'm Debbie Lee, and I'm a realtor with Bellator Real Estate, and I'm here just to learn more about investments.
I'm Kevin Ward. I've got a ground-up modular 4-duplex project in Oak Creek, Colorado, which is near Steamboat Springs. Just went to permit and in need of $1.1 million in construction financing.
This is Reiko. I'm here to learn about syndication. I have like 3 syndication I own part of, and then without knowing, I got in. So I like to learn here.
I'm Natalie Conrad. I do fix and flips and rentals.
I'm Evan Templeton. I'm with TCI Property Group, a small investment group here on the Eastern Shore. We work on both sides of the bay. My job is to find deals, and I talk to a lot of sellers, a lot of people, and that's super fun, helping people out of tough situations or situations where they need to sell quick or long, depending on whatever their needs are. So yeah, we're always looking for fix and flips and a seller in need.
Hello, I'm Angela Dager, and I came over with Jill from Pensacola, and I'm a wholesaler looking for off-market properties and end buyers, so always looking to add to my end buyers, cash buyers list if you're interested in single-family homes. I especially enjoy working with probate families.
I'm Nikema Wingate, and I'm just interested in learning more about this whole real estate process. My husband and I are kind of interested in understanding kind of what different options are available to us.
I'm Stacy McElroy with eXp Realty. We used to have a short-term rental on the beach in Gulf Shores. We 1031 that into a storage facility and enterprise, and looking to expand, purchase more storage facilities.
Sam Jeffcoat. I am a commercial banker here with Bryant Bank. Just looking for opportunities to finance commercial and investment real estate in Alabama.
Hey, Ryan Miller, newer investor, looking at single-family homes, fix and flips, and some buy and holds.
Hey, my name's Donnie McGriff. I live here in Fairhope. I've invested in Central Alabama, East Alabama, where I've lived, and now here. Do off market. So if you've got any questions like how to go direct to seller, and you just want to pick my brain or talk about it, ideas, talk to me. And I'm always looking for, if you're a wholesaler, get me on your buyers list because I'll buy from wholesalers too.
Hi, I'm Rob Schell. I'm with Innovate Real Estate, and I help cash flow commercial property owners anywhere in the United States through about 12 different tax services. Anything from single-family homes and condominiums that are short-term, long-term rental, all the way up to the biggest towers in America.
Marcus Allgood with Water's Edge Realty. I am Moore's buyer's agent, and I've helped Natalie and Praveen go to bat for, we had to do some battles for Natalie's latest flip, but I take all the headache out of it and let me deal with the headache, me and Moore deal with it, and y'all just spend your money, buy some houses.
Awesome. Okay, today's presentation I'm so excited about. Okay, once again, thank you to Tom and Fairhope Mortgage for our great food. Hopefully you guys all love the Lord's chicken as much as my toddlers do. I'm so grateful for Candace. Candace drove all the way from Birmingham to come talk to us today, and we met a long time ago in Birmingham, probably like 5 or 7 years ago. And watching you grow your company over the years has been amazing. I truly think that Candace and her partners run one of the very best syndication companies in the United States. So I'm just so happy that you came to talk to us. You guys are going to get blown away. Candace is so smart. And if you'd like to introduce yourself, tell us a little bit about your background. Love to learn more.
All right, well, thank you again, Maura, mainly for giving me an excuse to come to the beach for a few days. So my kids appreciate it. I think before I get started, so I heard a few of you during your introductions mention multifamily, but maybe just raise your hands if you've ever either passively invested or actively own any multifamily, like 5+ units. Okay, just so I get an idea of, just kind of level of experience and understanding. But if I come across any terms when I'm speaking or anything you don't understand, feel free to stop me. I think it's going to be informal, so just wave me down and I can explain it in a different way maybe. So I'm going to be talking to you guys about multifamily syndication. Multifamily is truly my passion. I love it. I've been through a couple of different lives getting to this point, completely different, unrelated industries, but I really found what I love to do, so happy to be talking about it today. A little bit about myself first before we get into the details. Like Maura said, I live in Birmingham, Hoover submarket of Birmingham with my husband and our 2 boys. They're 3 and 8, and we love to travel. So in this picture you can see, I think we're in Jasper, Canada, Canadian Rockies in that picture, but we love to, in the summer, we're like never home. We just travel all over because my kids love to explore, and so do we. And that's one reason I love multifamily, because it allows me to work remotely in a lot of cases and just touch base back at home periodically. So from 2012 to 2020, I actually had a different business in electronics wholesale. So this kind of led me to multifamily. I'll back up a second. I actually moved to Birmingham to pursue a PhD in immunology. I was miserable in the lab I was in. My boss at the time was kind of a slave driver, for lack of a better term. And I just worked crazy hours. My health was going downhill, all of that. So I left that PhD program, did not get my PhD, and fell into this business opportunity that I launched in electronics wholesale. There was no competition in Alabama at the time in the wholesale business-to-business model. There is now, but we had a really good run with that business, and that's what really allowed me to get into multifamily, because I had this excess capital. I just needed to invest somewhere, and I did not like the stock market because I couldn't control it. So I'm very type A, if you guys don't know. So I started attending conferences and reading books and just trying to figure out where in real estate I really wanted to focus. I did some private lending and invested in debt funds, did a few single family buy and hold rentals, but ultimately landed on multifamily by 2017, 2018. I really knew multifamily was what I wanted to pursue full time. So started that journey. My husband was kind of taking over the other business more. I was focusing on multifamily. And by 2020, I was full time. 100% of my time was focused on multifamily. So to date, I've done 20 multifamily deals actively, and then I've also invested passively with 7 different operators. So I have a 401k retirement account. I can't invest in my own deals with that account, so that's what I typically use to invest with others. But I do try to diversify a little bit, although I'm heavily into multifamily because I believe in it. So I'm currently the principal and director of asset management for Astra Equity. I met my Astra partners and started investing with them in 2020. So prior to 2020, I had bought my own multifamily deals. I started with a 40 unit that I did on my own without partners, and then bought a 30 unit after that, and then just kind of started expanding with joint ventures, and ultimately met my Astra partners and knew that I wanted to exclusively work with them because they're amazing. So 2020 and thereafter, I only worked with them. So a little bit about my company and my partners. There's 4 of us total. Jeremy Porto is our director of acquisitions. So his role day in and day out is really strengthening the broker relationships we have, negotiating purchase and sale agreements, submitting offers. He does all of our underwriting for us for new deals, and carries us through the due diligence process until we close a deal. There's a lot that goes into that closing process, and he really stays on top of it. If anyone thinks I'm type A, he is another level type A. He wants everything done yesterday. So he's a great person in the acquisitions role and great to work with. Like I said, I'm the director of asset management. So my role is I oversee all of our property management teams. I make sure that we are executing our business plan. We're staying on target with budget versus actuals. I review financials. I'm over the lender draw process for any renovation projects we have. And then I also oversee insurance renewals and property tax appeals. But most importantly is really just watching these deals like a hawk to make sure that we are on track to meet or exceed our pro forma. And then Rich Trepanier is our construction management partner. He's not really an on-the-ground construction manager like many of you may think of when you hear the term, especially from single family. But Rich is more high-level construction management. He oversees our construction managers, has calls with them weekly to make sure we're on target. He reviews any contracts from contractors and any bids to decide which route we're going. And he really helps make our budgets initially as well. And then Stuart Dukeman, his official title is Director of Business Affairs, but he really just fills any gaps we have. He has 30 plus years of experience owning multiple different businesses, so he knows how to grow a business the right way. And he also is great with the legal review side. So if our attorney sends us something, a draft, he's the one to kind of review it and give feedback, as well as investor communications. He's the one that's the primary point of contact, I guess, for investors, and our portal. He oversees all of that side. So we really each have our own strength and our own role, and it's worked really well together. So glad I found these guys to be able to scale. So I wanted to start with why multifamily is a solid investment. And some of you have probably heard these things before, but just wanted to touch on it for anyone who's newer. So I have recession resistant. Of course, I put a star because it depends. You really have to, if you're passively investing, invest with the right group, because if someone has not mitigated the risk that go along with multifamily investing, then obviously it may not withhold through a recession. But what we do is we make sure that we have long-term debt on our assets so we can hold through any recession. We don't do any bridge debt or bridge lending, or we haven't in the past. And then we make sure we have adequate reserves. We keep at least $1,000 per unit. So if we have a 200-unit property, we have $200,000 at all times in the operating account. We won't dip into it to distribute. And then if it's a distressed asset or a heavier lift, we'll have additional reserves on top of that as well. So we want to make sure, there's real estate cycles, right? So when it's cycled down and in a downturn, we want to make sure that we can just keep holding the asset, continue cash flowing until we're on the other side of that recession and we can sell when the market makes sense to sell. So that's why we always like to say a 3 to 7 year hold, because it's going to depend. Our business plan is always complete at the beginning of year 3 based on how we model a deal. We should be able to sell at year 3 and meet pro forma. But we say 3 to 7, and we underwrite for 5-year hold because of that cushion, because you just don't know what the market's going to be doing at that time. So the 4 main ways to profit from multifamily. Cash flow, right? I mean, that's kind of the given that everyone loves about any buy and hold rental is the cash flow. After the mortgage is paid and all expenses, whatever's left over can be distributed as cash flow. Second way is principal pay down. That's self-explanatory. You're paying down the principal on your loan over time. And then 3, appreciation. So there's 2 different types of appreciation in multifamily. The organic appreciation would be like your market appreciation. Basically your rents go up over time because of inflation. Expenses are typically around 45 to 50% of income. So if everything goes up 3%, if rents go up 3% and expenses go up 3%, you're still growing your value of your property because income is double what expenses are, if that makes sense. So there's that market appreciation that we don't bank on. It's kind of just icing on the cake if we get that. What we're looking for, though, is forced appreciation, which means a value add opportunity, a way that we can get in there and increase the value of the property through improvements that we do, a lot more controllable than the market appreciation piece. And then the 4th thing is the tax benefits. So this was actually one of the main reasons that initially drew me in, because when we had the electronics business, we were in the highest possible tax bracket. It made me physically sick every time I had to write a check to the IRS because it was so much money. So the tax benefits allowed me to benefit from the depreciation of multifamily, and through allowing my husband to take over the electronics business and me to focus on multifamily, I qualified for a real estate professional, and I was actually able to use that depreciation from the multifamily properties we were buying to cancel out a lot of the income that we were making from that other business, and it was just a huge benefit there. So anytime we buy a property that's greater than $1 million in value, which is like all of them for us, and if we're going to hold it more than 3 years, then at that point we'll go ahead and have a third party do a cost segregation study, because that allows us to accelerate depreciation. So it basically reclassifies all the components in a multifamily property into 5, 7, or 15 year versus 27 and a half. So we're able to accelerate that depreciation, and we also elect bonus depreciation, take all that up front to where we get a large write-off. Now I'm hoping the bill that's currently in passes, or some variation of it, to where 100% bonus depreciation comes back this year, because if that bill passes, it'll be retroactive to January, in which we closed a large asset in March. So if that comes back, it's going to be huge for us. But if not, it's still 40% bonus depreciation this year, and it's still a nice benefit there to where you can write off a large chunk of your investment the first year. There is depreciation recapture, but you still always come out ahead. I say always in quotes because it depends on everyone's personal tax situation, but assuming you're in a higher tax bracket than 25% right now, you would come out way ahead by just recapturing it at the 25% recapture rate. So consult your CPA if you want to know more on that, because I'm definitely not one, but that was a big lure for me when I first got in. But my favorite benefit, my favorite profit center of all of this is really that forced depreciation piece, because that's something that is tangible that I can easily execute and control, that I know I can get my value. And what's great about the forced depreciation piece is if the market does downturn, if values go down, if cap rates go up and values go down, if we have a value add piece or a forced depreciation piece, then we can actually counteract that and we don't have negative equity in the property. You know, say there's a 30% downturn in multifamily, but we've increased the value of our property by 30% through a value add, at least we're not negative equity and we can just wait on the market to come back and cash flow in the interim. So that's one reason I like that. So I wanted to make sure everybody understands how multifamily properties are valued. So, you know, if you don't understand this piece, then the forced depreciation may not make sense. So I know some of you already know this, but a multifamily property is valued by the net operating income that it produces divided by the market cap rate. So the net operating income is simply the income minus the expenses equals the net operating income. So it's before debt service. And then the market cap rate, that's something you can't control. You can't control that variable. That's determined through appraisals, and a cap rate just means the rate of return if you buy all cash. But anytime you sell a multifamily property, the appraisal will determine the market cap rate because it depends on other sales in the area. So in a down market, cap rates go up, which makes values go down, but as long as you're able to increase the net operating income, you can still come out ahead. And if both go in your favor, if the market improves and you increase your value, well then that's when you really make some good money. So here's some ways that we add value. The number one way is raising rents. But we don't just go in and jack up rents on these residents. You know, we're not like the evil landlords that you hear about in the news. What we do is we wait until the units organically go vacant. So industry standard is around 40% of units will turn a year anyway. You know, people buy houses or get transferred. So that's how we underwrite our deals. We assume 40% will turn in the first year, 40% will turn in the second year, and then 20% will turn in the third year. And we actually put a cushion on the front end. So it spans over about a 3-year period, our business plan. So whenever residents leave on their own, we'll at that point go in and renovate their unit, and then we can charge more in rent. You know, it may be anywhere from $100 more to $300 or $400 more, just depending on how far under market rent it was to begin with. And that's one way we drive value. We also, through doing that, will typically attract a much better resident profile that will pay rent better and maintain the property better. So we usually aim to buy like a B or C class property in an A class area or a B plus class area. That way we can take an unrenovated, maybe like an 80s product that has green carpet, and we turn it into like a nice renovated apartment that you'll have a good white collar working class resident renting. There's also other income items that we use to add value. Maybe like pet rent or application fee, whatever the market's charging. So we look at market comps to see what's standard in this market, and if the property is not already charging that, such as water sewer chargebacks. That's a big one that some properties don't charge, but it's very common to charge a resident for that. So we'll go in and implement that when we buy it. And then of course, decreasing vacancy and bad debt. So if the property was poorly managed before, we can come in with our property management team and at least reach or exceed whatever the market vacancy is and decrease bad debt through our collections efforts. And then on the expense side, we look, when we underwrite a property, we always look for anything that's above the norm. Like we look for ways where we can decrease expenses to add value. So a lot of times that'll be renegotiating service contracts. Maybe they're paying way too much for trash or landscaping, and we have our landscaper over here that can do it for less. So we'll either renegotiate with the current providers, or we'll wait till that contract's over and put in our own providers there. Sometimes if it's an older property with like 3.5 gallon per flush toilets, we'll go in with newer low flow toilets and fixtures to save on the water sewer bill. So that's one way that we add value there. And then just really knowing our market, because there's so many little nuances of each submarket within a market even that you have to know the expense. And sometimes we may see an opportunity whereas other groups, especially out-of-state groups, would not because they don't know the averages. So I feel like we have a little bit of an edge there because I didn't mention in my intro, but everything we own with the exception of one property is in Alabama. So we're very hyper-focused on our markets and we know our averages and we can look at our portfolio and say we average X per unit for this or that and know exactly how to underwrite a new deal. So I feel like that helps as well, not get us in trouble like some other groups. So a few different ways to buy multifamily. And I kind of went in order here. So like when I started just using my own capital from the other business we had, bought my own deals, and then I went into joint venturing or JVing. So that's like where you'd have 1 to 3 partners. Everyone typically in multifamily puts in money and everyone has an active role. Typically, that doesn't mean it's not done a different way. But what's important with a joint venture is every partner has to be active in some way or have voting rights or contribute to the success of the deal, because you can't just have someone just put in money and do nothing in a joint venture or else it actually breaks SEC laws. So you have to be very careful with that. So once a deal reaches a size where you don't have a couple of partners that you know that you trust to partner with you on it actively, at that point you have to move to syndication. Syndication is simply a way for multiple investors to pool money to buy these larger assets. You typically have an operator or a GP, and then all your passive investors are the limited partners or LPs. And in a syndication, it's much more strictly regulated, so we have to obtain an exemption from the SEC. And there's a lot of red tape there, a lot of paperwork, a lot of filings. So that's why there have been a lot of groups that try to get away with joint ventures when they should syndicate, and some of those have gotten in trouble. So it's very important if anyone does want to do this actively, just pay the extra money to syndicate if you're going to have more than 1 to 3 partners, or if your partners are not going to be active in some way or have voting rights. So I wanted to talk through kind of the returns we look for and the terms of the returns we look for, and then the structure of these things. So for the returns, there's 3 main terms you'll hear if you're looking at a multifamily investment. The first one is average annual return, or AAR. This is probably the most important for most people. I see most people most interested in this one. And that's simply your total return over the hold period divided by your initial investment amount divided by the number of years of the hold. So it's an annualized total return of all. It counts cash flow, it counts profits from the sale, so it's an all-encompassing annual return. Then your internal rate of return, or IRR. It's similar to AAR, but it takes into account the time value of money. So if you have a syndication where, say it's a heavy lift, like you buy 10% occupied or something and have to lease up and there's not really any cash flow and you sell at the end of year 2, you have a big payout at the end, then your IRR will be less than your AAR because all your profit's coming at the end. Whereas a heavier cash flow deal with more cash flow at the beginning would have a higher IRR because it's assuming you can take that money and then reinvest it into something else. So if you're interested in more of the time value of money and how hard your money is working, then IRR is important. And then the cash on cash return, that one is simply cash flow. Distributions you've received along the way does not take into account the profits from the sale. So we look for 17% or greater per year in average annual return, and of that, around 6 to 8% a year would be your cash flow or cash on cash return. The last few deals we've had have been a little bit higher returns than these because the market's a little bit down right now, so we're finding even better deals. But in general, that's kind of what we've targeted. So on the structure side, like I mentioned a second ago, you have general partners or GPs. That would be us if we're syndicating the deal. And then you have your limited partners or LPs, which are the passive investors. And they're called limited partners because liability is limited to your investment amount. If you're investing in one of these deals, you can't be sued for, say the property does something it shouldn't do. The limited partners can't be sued or anything like that. They're just limited to the investment they put in. But every member, whether an LP or a GP, will own a percentage of the LLC that holds deed to the property. So essentially everyone owns a little small piece of the property, and that's how that's structured. So there's a lot of different ways that operators structure syndications. I'm going to talk about the way we do it, but just keep in mind that, if you're ever looking at anyone else, any other groups offering, it may be different because everyone kind of has their preference. So what we do is we offer a 7% preferred return, and then after the 7% is met, profits are split 70-30 thereafter. So 70% to limited partners and 30% to us, or general partners. So you see at the top there of this little chart, profits. That could be cash flow. That could also be profits from the sale. The first 7% would go to investors, and then we would split. So it's structured that way because it really just puts investors' interest first. Like obviously the deal has to perform for us to really get a good payday there from that 30% promote, as you may hear it called. So the promote just means the 30% share we would get after the preferred return is paid. I just wanted to note too that a lot of times the GP side will be split among multiple groups as well. So in all the deals we've done, we've never split the GP except for one time. There's one deal where we brought in an additional group as well to help, primarily with the capital raise piece. But in a lot of groups, you will see like multiple different GPs splitting that share, especially for larger assets. And then there are fees as well that we charge. So there's basically two ways we get paid for doing this, for all of our work we put into seeing these deals from start to finish. It's that 30% promote, and then there's the fee. So we charge an acquisition fee, which is usually 2 or 3% of the deal, of the purchase price going in at closing. And then we also charge an asset management fee, which is 2% of the cash generated, the revenue. And then sometimes a 1% disposition fee. That one kind of varies depending on the deal. But those fees are typically paid regardless of performance. Like I said, the acquisition fees paid up front. Asset management fees are paid throughout. But if we have a deal for some reason that's not performing, then we would forego those fees. But every operator is different. You really just have to see the PPM for details. So if you ever invest passively in a deal, there'll be a PPM you review, private placement memorandum, to where all of those details are laid out. So you just have to make sure you understand how everything is flowing there. So what do we look for in a deal? Number one is some value add piece, because if there's not a way we can force appreciation, we're essentially just buying a cap rate, and we're never going to be able to meet those returns that I mentioned in an earlier slide. So that's most important. There has to be, and even if we don't go in and renovate, maybe they're just under market rent as they are, or there's some big expense that we can reduce. So there's a lot of different ways, but we got to have a value add. The second thing is it's got to be in a growing market with low crime in Alabama. We have that one asset in Mississippi I mentioned. That was kind of a special. It was too good to pass up. It was a broker we know from Birmingham, so we bought that one, but it's 123 units in Tupelo. But usually we look for deals in Birmingham, Tuscaloosa, Huntsville, Coleman, and the Millbrook, Prattville area of Montgomery. That's our target markets right now. We haven't bought anything coastal. We're not really looking coastal right now. There's a lot of insurance risk with coastal. I think the insurance market is finally softening a little bit, but the last few years we've stayed away because we didn't want our insurance premium to 10x. And then, like I said, returns. I already mentioned the returns we look for. So if we have a deal on our desk that looks like there's some value add piece, it's in a growing solid market with a lot of job diversity and population growth, and we can meet these returns, and at that point we would pursue it. Anywhere from, right now we're mainly looking for like 100 units to 350 unit properties, but we have bought a lot of less than 100 units. We're really just now over the last year trying to just focus on the larger assets. So understanding the risk. I mean, this is important in any investment. You really have to understand there's risk in anything, you know, you invest in. What's important is knowing what they are and mitigating them the best you can. So market risk. This one is kind of a given. You know, any real estate that you invest in, there's going to be cycles. So if there's a recession or a downturn in the market that causes cap rates to go up, such as when interest rates go up, cap rates go up. So even if the market is solid from a like an income standpoint, you know, rents haven't gone down. If cap rates go up, your value goes down. So in that case, the way we mitigate that, I mentioned earlier, I think, is the long-term debt and just the robust reserves. So we want to make sure we can hold through a downturn, keep cash flowing. You know, maybe we're cash flowing at 7-8% a year, and then we sell on the other side, and we can still meet our pro forma at that point. But I guess if there ever was like a Great Depression that lasted greater than 10 years, then at that point, then there's more risk that it just can't be mitigated, other than hoping we can refinance at that point and have enough positive equity to refi and hold longer than 10 years. And then property risk. This would be things like, you know, hyper focused to a certain area. So maybe we buy an asset that right across the street, they decide to build a 300-unit community and offer 2 months free rent concession to lease up. So like absorption risk, to where rents are not able to be increased or have to be decreased for a short time until those units are absorbed. Or any expense surprises, or renovation overages. I'm sure any of you that flip know all about the renovation overages. They're common. But the way we mitigate that is really just hyper-focusing on our market and knowing those expenses inside and out, knowing our renovation budgets inside and out. We use the same crews. We know exactly what they charge. You know, we just try to base everything on real historicals and averages and put an escalator on that to assume further inflation when we underwrite. And then, of course, we pivot when we need to. So I keep a very close eye on our properties, and if I see that we're not trending in the right direction, then I want to pivot early and really just be proactive instead of reactive. So, for example, we have one asset right now. We have 17 assets we're still holding. One of those 17 is not meeting rent projections, and the reason is because the new supply issue. So this is in an A+ area of downtown Birmingham. There's been a ton of new development around that, primarily one bedrooms that are offering 1 or 2 months free rent. Our asset, it's granite, stainless steel appliances, so it's kind of in that same class as the new product, and they're all 1 bedrooms as well. But you know, we don't want to offer 1 or 2 months free. We might as well just drop the rent, or we could do either or, but the bottom line is the same. So what we've done to pivot on that asset is we've found another value add, a way we could value add. So we've started going in, even though it wasn't in our initial business plan, we've started going in and adding washer and dryer hookups to the units because we found we can charge from about 100 to 150 more per unit with those hookups. So we're able to increase our property value that way. So it's really just always watching these deals closely and knowing when to pivot. And then finally, timeline-specific risks. So I just always like to tell people that these are illiquid investments. So if there's any risk that you'll need the capital, you know, don't buy multifamily. It's just not a good fit if you need the capital in a shorter period than 3 to 5 years. How am I doing on time, Maura?
You're doing good.
How much time do I have left?
About 15 minutes.
Okay. I didn't practice this, so I have no idea how long it is. This was kind of last minute. All right, so I wanted to walk through one of our current deals. It's a case study of 87 units. This is in the Birmingham MSA in Shelby County. So we bought this deal back in May of 22. It was a $6.1 million purchase price, which comes out to around $70,000 a unit. It was built in 1999. And you can see the middle row here was the returns that we had projected. I actually pulled this slide directly out of our investor presentation back in 2022 when we raised capital for this deal. So these were the initial returns we projected, and you know, all the other information there that was shown. And then this slide shows your sources and uses if anyone's interested. It shows where the capital comes from. So the chart on the right, we obtained a loan for a little over $5.6 million, and then we raised $1.9 million for this deal via syndication. This raise is on the smaller side for our syndications. Our last one was like a $6.8 million raise. This one's a little bit smaller asset, but I thought it would be a good one to talk to you about today because we actually just closed a refinance on it last week. And you can see over here on the left what we use the money for, or the uses, the purchase price being 6.1, and then we also have our operating reserves and capital improvements. You can read that. I'm not going to read it to you, but a lot goes into these deals. So even though this property was 1999, I don't know who developed it, but they had 1970s taste because it had green carpet throughout, green countertops. I mean, it did not look like a almost 2000 vintage property. So it was very ugly, no renovations whatsoever. None of these units had ever been touched. So you can see what we did over here on the right. We went in with LVP throughout and a faux granite Formica counter. The new plumbing package, electrical package, black appliances. It's really modernized it, took out all the green ugliness. And then on the exterior, I wish I had a better exterior picture, but I didn't have a chance to trade this out from a previous presentation. But you can see on the left, they loved green. They had green railings, green shutters. They have a lot of rotten wood and really just deferred maintenance. The previous owner didn't take care of it well. So when we took over, we added a more modern shutter. So we took off the old shutters and added a more modern gray wood shutter, and then painted all the railings and stairs and back decks a darker gray, replaced a lot of them. Did a lot of pressure washing. We replaced roofing. Landscaping cleanup alone was a pretty large ticket item for us because they had let it overgrow. Then we also added a dog park and grilling stations. If we have room, we always add a dog park and grilling stations because it's an inexpensive value add. We can usually do that for less than 20 or 30 grand, and it attracts, especially the dog park, attracts pet owners. And we charge a pet fee, and pet rent. So that's one way we can increase our revenue. I know some single family owners don't like taking pets, but we love pets because as long as you do it in volume, you always come out ahead. As long as you charge the extra fees and everything. Yeah, they're going to damage some, but you can also keep their deposit. So it works out. We come out ahead that way. That just shows an exterior photo. There's the little dog park. The little bone sign there gives the rules. I don't think you can't see the grilling stations from that picture, but. So this graph, every month when I review financials, I also review all the KPIs, and I put together a budget versus actuals graph that goes to investors every month along with a little report. So this one looks like it's through March of 25 when I pulled this. This shows, you can see the solid lines are the actuals, our actual performance, and then the dotted lines are the budget or our initial underwriting, initial pro forma. So green is income, gray is net operating income, and red is expenses. So it shows how we've tracked. As you can see, our income for this property has far exceeded our expectations. When we took over, the rents were $634 on average. Today, we're signing leases on 2 bedrooms at $1,050, and then on 4 bedrooms at $1,350. So the rents were so low because of the condition of the property. It really had, even though this is an A-class area, like it had some drug dealers we had to get rid of, and it was really just poorly managed. So this was a heavy value add deal that we've been able to outperform on, thankfully. So we've owned this deal for a little over 3 years. So like I said earlier, at the 3-year mark, we've completed our business plan. So typically at that point, we would look for, does a refinance make sense or does a sale make sense? So as I said, we bought it for 6.1. We put in about 1.1 million in capital improvements, and we just got our appraisal back in April for 11.1. So that shows the value add piece there. So we decided to refinance this asset rather than sell, because it's in a really good area, and our property manager's feedback is that residents in this area would appreciate more premium upgrades as well, like granite, stainless. Now that we've turned the whole property and have what I would call like a B-class tenant profile, I think at this point it would support a phase 2 where we can go in and renovate with premium finishes and keep pushing revenue up. So we decided to do that. We're going to prove the concept for the next buyer. We're going to go in and renovate 10% of the property with the solid surface. I think we're going with quartz and stainless steel appliances and more upscale light fixtures and things of that nature, and tile backsplash, and push rents another like $150 to $200 per unit. So we obtained a Fannie Mae loan on this at a 5.77% rate with 3 years of IO. We just closed this like last week, so these numbers are still preliminary. I have to wait for June to close out before I can determine exact numbers, but we anticipate returning about 80 to 85% of investor capital through this refinance, and that's even with holding back about $400,000 to go towards the phase 2 renovation. So investors previously, the deal was cash flowing about $9,900 a month before the refinance. After the refinance, it'll be cash flowing about $7,700 a month. So still healthy cash flow, but investors will all keep their percentage of the property. They keep the same ownership. They keep cash flowing with 80 to 85% of their capital return. So we thought that was the best fit right now, especially given the market is, we could have sold this and far exceeded returns, but I feel like by holding another 2 or 3 years, I think we'll really even do better for all of our investors by doing that.
Is there a discussion with your investors?
So we did, some of our larger investors, we actually went to and talked to them about what they thought about a refi versus a sell and kind of gave all the numbers. But we didn't like formally have them vote or anything like that. We don't typically, because the thing is with voting on a larger scale, you're always going to have some people that want option A and some people that want option B. And then the ones that wanted B and we went with A tend to feel like we didn't take their thoughts into consideration. But yeah, we did talk to a few and they were all on board with the refinance. I feel like it's always a win when you can get most of your capital back and then still be cash flowing at this close to the same rate as before. You can then take that capital and put it into another deal, and it just really amplifies returns at that point. So cash on cash return a year, this isn't even counting sale proceeds when we do sell it, but the cash on cash return post refi will be around 40% based on the capital that's still in the deal and the amount of cash flow they're getting. So made sense. And one thing I didn't mention here that I know I've mentioned our property management teams a few times. I wanted to bring this up real quick because I think this is important. If any of you guys are thinking about buying multifamily actively, property management is everything. I mean, it makes or breaks any deal. And having the wrong property management company, you can be the best operator in the world, and it's just, you're going to end up switching, and it's a hard transition. So make sure that you really put a lot of time and thought and interviews into that process. When we first started, I could not find a company in Birmingham back in, I guess when I was trying to buy my first deal in 2017. I couldn't find a company that I felt handled the smaller assets well. I think, Maura, you have a solution for that now. I don't think you did back then, but I couldn't find a company that handled the sub 100 units well at that time. So I actually partnered with a guy who has over 20 years of experience in the property management industry. He was a regional for a lot of large multifamily property management companies, but he always wanted to be on the ownership side as well. And he wanted to do his own thing. So long story short, we kind of aligned, and we have a close partnership now where he's grown out his company as we've grown out our company. We don't own the management company, but also they're exclusive to us. They only manage for our portfolio. So we have a lot of control and a lot of say. Like every hire that's made, we approve, and it's really just the best of both worlds. It really allows us and them, the management company, to hyper focus on our portfolio. They don't have multiple owners they're dealing with that wants things done multiple different ways, so they can focus on our growth. We can focus on our growth. So anyway, I just wanted to bring that up. That is one piece of this that I feel like we have been very fortunate to find that individual that's been able to grow his company alongside ours, and we give him a little piece of equity in each deal that steps up over 3 years. So he's really incentivized to perform.
That's really good.
Dana?
Candace, on that slide there where you say y'all refinanced, I think it was, and you returned 80 to 85% back to the investors. Mm-hmm. And then let's say you hold it another 3 or 4 years and then sell it and you have profit. a percentage of that profit also goes back to the investors, doesn't it?
Yes, absolutely. Yeah, so every investor still maintains their same ownership percentage of the deal. So yeah, when we go to sell the deal, they're still going to get their share of the profits at that time. For this deal, if we had sold today, the returns would have been around 29% average annual return over the 3 years we've held it. That's what based on our appraisal, that's what we would have gotten. We ran the numbers, whereas if we held it for 3 more years and we didn't increase the value beyond, I'm trying to think of how to word this without having to go into like another 20-minute detail of it, but beyond like loss to lease. So we didn't account for the premium upgrades at all that we planned to do. But if we held it another 3 years for a 6-year hold, it would have also been a 29% average annual return. But the way that we thought about this was, we know this asset super well. There's no surprises. We've already operated it 3 years. 29% annually is a great return. Why would we not hold it for 3 more years and have 3 more years of benefit at 29% a year in an asset we know so well, versus moving the money to a different asset, a new asset, where there's going to be unknown risk in any new asset. So that's one reason we chose to continue holding it as well. It's not that the overall return when we sell likely won't be that much higher, unless these premium upgrades and these other value add pieces we were adding in are successful. Then it will be higher, but we weren't banking on that at the time. But it's just a win to, who would pass up 29% at 3 more years? I'll take it. All right, so that is it for my presentation. I'll open it up for questions. You can see my email here and our website. If anyone's interested in talking more about investing in multifamily, whether it's with us, we don't have any current opportunities, but we hope to have another one, maybe towards the end of the year. We typically do about 2 or 3 a year at most. But if you have any questions or just want to talk multifamily, I'm always happy to set up a call.
Do you have any advice, like if someone's listening to this presentation, they're thinking that this might be what they want to focus on, how to get started? Or maybe you could talk about a little bit how you got started, if you had to think back and advise someone else.
Yeah. So I think first you really just have to immerse yourself into the space, because there is a lot of lingo. Like I'll find when I go to like local RIAs in Birmingham, I'll be talking to somebody sometimes and they're like, you're like talking a different language. And I don't realize it because I've been in it for so long, but there are a lot of terms, like I didn't even bring up today, but a lot of terms you need to know. And the best way to really like speak the language is attend a lot of multifamily conferences, read multifamily books, listen to multifamily podcasts, just immerse yourself into the space, because when you start talking to brokers, you don't want to come across as a newbie. You want to speak the language and get that instant credibility by really knowing what you're talking about and how to talk about some of this stuff. So that would be my first piece of advice. And then secondly is I started by investing passively first, because it really gives you a glimpse of how different operators do things differently. So you'll get monthly reporting and you can comb through financials and see how, it's easy to see a business plan on paper, but seeing how these things actually play out in real time is something else. So by investing passively with several different groups, I was able to see, well, I don't like the way this group did this, but I like the way they did this. And I was able to take bits and pieces of each of these experiences and apply it towards, it's experience, but it's not, you're investing passively. So it's not the same as buying your own apartment complex, but there is still an experience component that at least helps arm you to then go out and buy your own deal after that. So that would be my 2 pieces of advice to get started.
So y'all get all your deals through brokers?
Mostly. We've gotten a couple through our property manager because, like I said, he had 20 years of experience. So he kind of knows every property and every owner, and he's just well connected in Birmingham. So we have gotten a few through him where he knew someone wanting to sell. We've gotten 2 of our smaller deals through direct to seller. But the larger ones, they almost always list with a broker because they just know it doesn't benefit them to sell direct. So most of them are brokers, yeah.
So that's what I was going to ask next. If you were starting out, would you say your best bet is to try on your own to do direct to seller before? Because why would a broker really take you seriously about sending you deals? Or should you just have something in place other than just knowing them? Because from what I understand, a lot of these deals are made before they hit LoopNet or whatever that is. Is that, yeah?
That's true, but I think a combination of both strategies is useful. Direct to seller, if you're looking for less than, say, 30 units, then you might have some success in that space. Somewhere around the 30 to 40 unit range, like they're more sophisticated groups or institutional that's going to not sell. They're not going to answer a mailer or something like that. But if you're looking for the smaller stuff, I think direct to sellers is worth trying. You could even look on like apartments.com or rentals.com or Zillow or wherever and try to find places that look not renovated, like owned for a long time by the same owner. They haven't touched it yet. Maybe rents are low. And that might be the ones you want to target direct to seller because they're probably not experienced groups. It might just be like a mom and pop or something. And then on the broker side, figure out your source of capital. So like if you're using your own capital, then when you contact a broker, I would show a bank statement. I mean, that's what I did when I started. I was like, here's the money. Like, I can buy this. Give me a chance, because if you contact them and don't show them some type of proof of funds, then a lot of times they will just dismiss. But I will say, I would have definitely said that a few years ago, but now that the market's a little softer, I think brokers are a lot more likely to talk to newer investors and give them a chance because there's not quite as many buyers out there, not as much competition as before. Now, if you're not using your own money and you're using someone else's money, or you're raising money, or just, I guess, figure out your source of capital and make sure to include that in let the broker know where the money's coming from when you're contacting them.
Do you ever look at the different types of buildings that you're going after? I saw the 100 to 300 unit type market, but the scope of the buildings, 2-story, 3-story, 4-story, where do you cut it off, knowing what the expenses can be for larger buildings, but there's also other tax advantages for larger buildings as well. Have you guys kind of looked at some of that as you grow your company?
Yeah, so one of our points of criteria is the vintage. We won't look at anything older than 1970s. We actually prefer 1990s, but if there's a 70s or 80s asset that's compelling, we will pursue it. But because of that vintage cutoff, it typically is garden style. We don't see many, multi-story, newer, other than like brand new construction, right? And there's not enough value add in those for us to pursue. So we don't typically look at like a 2024 construction 10-story apartment complex because we wouldn't be able to meet the returns that we target. So pretty much everything we own is garden style, 2 or 3-story type buildings.
I had a question about the depreciation. Can partners take the bonus depreciation at different scales, like, or is that kind of set by what the whole deal is doing?
So it's based pro rata on ownership. So because it's a 70-30 split, 30% of the bonus depreciation would go to the GPs anyway, but then the 70% would be split pro rata based on how much.
Individual partners take it at different times?
At different times, no. It would be, so we issue a K1 to each investor, so it's just going to pass through to all the investors based on that. But like one little thing we do to help boost our depreciation is when we have retirement account investors that can't use it anyway, then we actually have in our PPM where that depreciation is passed pro rata to all the other investors, basically to where it kind of boost total depreciation up a little bit, and we just issue like a 0 K1 to the retirement account investors. They can't use it anyway, so might as well use it somewhere.
When you do improvement projects at a later date and in later years, do the investors get a portion of that depreciation in later years?
You mean like if we have a renovation project, like a phase, like a phase 2?
The bonus depreciation that would flow through.
Yeah, so we haven't done that yet, like a second cost segregation study on the renovations piece. We likely will on this new asset that we just purchased, is 241 units in Hoover, because it's a $4 million renovation, so it really makes sense to go ahead and do a second one. But one thing we've done with our previous assets, it's kind of worked out on a lot of them where we buy them early in the year and we go ahead and knock out a lot of the heavy renovations and then we do the cost seg at the very end of the year, so it already takes into account a big chunk of it, and then what's left is not really worth a second study to benefit. So Just depends on the asset, how big the renovation budget is, and what time of year we buy it, and how much we can get done before the study's done.
You shouldn't be being charged for the second phase too anyway.
I guess I'll negotiate that better. We have a pretty competitive rate because I think up front we save a lot versus other cost seg groups because we bring them a lot of volume. So
when you're looking at markets to see if you're going to invest in whatever market you're looking at, what software or any other type of stuff are you using to determine like income, growth rate, things like that?
we like city data, and then also best places are two that we like to look at for like average home values in an area, renters versus owners, income growth, job diversity, population growth. But at this point, we know the markets we're in pretty well, so I haven't actually used those sites in a minute, but like when I first started, I was using those a lot, and now I just kind of know where I want to buy and where I don't, so we don't look as much.
City data, what was the other one?
Best places. I don't know if that's .net or .us or but if you type like best places Birmingham, Alabama, or best places Hoover, Alabama, it should be like the first one you'll see.
Okay.
Yeah. Any other questions?
Awesome. Well, thank you, Candace.
Thank you.
So there's different types of investment products that we use, different investment properties, right? A lot of people in here are going to do single-family homes or multifamily homes. We love midterm rentals as well as short-term rentals. So a midterm rental, think about a house near a hospital where nurses are going to be coming and staying for 2 to 3 months. Those are great because it reduces the wear and tear, but you still get the higher dollar amount of like a short-term. We could do commercial properties, condos, fix and flips. And one of my favorites on here that makes you the most money is what we call a kiddie condo. So like my daughter's 17 years old. She's got to pick a school next year. If she decides on Alabama or someplace in Alabama, we get in-state rates. But if she decides to go someplace else, that can increase tuition like $30,000 a year. What you can do is you can buy a house near the school, put her on it. It can be an FHA loan, even a zero down loan. And then within a year, she's going to start getting in-state rates for tuition because her name's on that house, she's working in that state. And you're talking about saving $30,000 a year, in addition to the fact that her friends at that school living with her are going to be paying the mortgage for her. So you really come out ahead with those. So I mentioned leverage. And a lot of you guys already know this, but if you go out and buy $100,000 worth of Apple stock, and it goes up 10%, you made 10 grand and you did great. Like, that's good investment. But if you do the same thing with a house and you put down 20%, you've only invested $100,000, but you've bought a $500,000 home, right? When that goes up 10%, you've made $50,000. So the power of leverage over the course of 30 years can mean instead of being up almost $2 million, you can be up almost $6. So even you can keep your costs low by using your own funds when you buy a property and you're going to hold it. But if you leverage that into being able to buy 4 or 5 properties for the same investment, you can come out ahead over the course of 20, 30 years. And then one of the best things I think is buying single-family residences and just holding them for the long term. And these are those multiple income streams we were talking about, using historical averages. You invest $60,000 to buy a $300,000 home. 30 years of appreciation is going to be 900 grand. You're going to pay off your $240,000 in principal. Cash flow over that time period is going to be about 1.1 million. A bunch of tax savings. You can total out that investment $2.4 million over that time period. So buying and holding single family can be very powerful. I'll send this out to everybody that put their email on the sign-in sheet. This is just a spreadsheet that we can use to calculate cash-on-cash returns, ROI. You can change rental amounts, how much you're going to increase rent every year, and give you a really good look at what your investment's going to do. It includes renovation, everything. So I'll send this out to everybody. I don't expect you to be able to read that. Okay, now the good stuff. financing options, okay? So everybody knows the good old conventional loan. We can use those to buy an investment property, condo, house, whatever. No problem. Many of us are business owners and have great CPAs, right? And maybe on paper it doesn't look like we make as much money as we might really make. This is perfect for the DSCR loan. It stands for Debt Service Coverage Ratio. Basically says if this house is going to pay for itself, we can do the loan. You can also do commercial or hard money, fix and flip loans, and then there's some creative financing you can do. You could do it seller financed. You could do a subject to deal as a seller. I would never in a million years do that. As a buyer, it makes a lot of sense. And then you can form partnerships. Maybe you have the know-how to do it and the contacts to do the rehab, but you need a friend that has some money. You can create a partnership to buy the properties. All right, so DSCR loans are kind of like my bread and butter. They're about 40% of my business, whether they're condos for millions of dollars or $50,000 homes that are going to be Section 8 homes. What we're going to do is we're going to add up the monthly costs, so principal and interest, tax and insurance, and any HOA if there is one. And then we're going to compare that to the potential income. And you want that ratio to be 1.0 or higher, right? You want the property to pay for itself. The goal is 1.0. The higher the number, the better your interest rate's going to be. If you go below 1, but you still want to do the deal, your interest rate's going to be a little bit higher. It's a little bit riskier for the bank. No job, no income. I don't care if you work at all. That doesn't matter. All of the income is coming from the property itself. They're usually 20% down. If it's a condo that's been rented on Airbnb or Vrbo, then we can use the historical rents from that to be able to show what it's going to earn. If not, then when we get the appraisal, we order a schedule of rent. It could be long-term if it's a house. It could be short-term if it's a condo. We're going to show what the rental income is going to be. They're going to compare it to other properties in the area. I just did one at Turquoise Place down at the beach. I mean, they literally had 3 properties on the same floor. So it really helps you identify what others are renting for and can help maximize what you're going to get for rent too. Typically, these are 20% down. There are some options at 15. They're not pretty. And if you go to 25% down, you get a little bit better rate as well. Everybody loves it when you call it this. So when you're getting started in real estate investing, house hacking is a very simple way to get in, right? You're going to buy your first home with an FHA loan, maybe a VA, whatever it is, and you can buy a 2 to 4 unit that way. You're going to live in it for a year, right? You got to actually move in. You can't just start renting it out. But you live in it for a year and then you start buying a new primary property at 5% down using a conventional loan every 1 to 5 years. Or you can even buy a second home and only 10% down. So this helps reduce those upfront costs for you. You can start this process very early on and keep renting the other ones. And this is an example of somebody buying 5 houses over 10 years, right? You're going to buy the first one in year 1, year 3, year 5, year 7, year 9. All of these were $400,000 purchases with 5% down. So over 10 years, the first one would be worth about $650,000. You'll have repaid $81,000 of principal, remaining mortgage of almost $300,000, meaning you have equity of $372,000. You're going to do this for each house. Obviously, the one you buy 2 years before the end of the 5 years is only gone up $41,000, all right? But what's that mean? It means at the end of those 10 years, you have equity of $1.1 million just by moving 5 times. So you're getting in for very little money each time, and you can end up with $1 million at the end of 10 years. Talking about building the portfolio, that's less important for what we're talking about today, except for diversification. If you're going in and buying condos in Orange Beach, and that's your first purchase, don't make your second purchase in Orange Beach. I understand the appeal of wanting them in the same place, but a hurricane comes through and all your properties are out of commission at once, right? Spread it out a little bit, about the width of a hurricane. And that way, if one goes down, the others are still operational. And then you get into seasonality after that, right? You might buy 2, 3, 4 beach condos. It might be time to buy something in the mountains so that your income coming in is seasonally adjusted. In the wintertime, there's not your slowest season, basically. Questions?
Do you guys have loan minimums for your DSCRs?
$50,000, yeah, which comes out to a purchase price of $62,500. I have 4 of them, basically all right around that price point right now in Mobile. Maximum right now is $3.5 million for like a condo, and then we can do multifamily stuff, but that's more like 30% down when you're talking, 10 units plus.
Are you licensed in Florida?
I'm licensed in Florida and Alabama. The DSCR loans, there's no license needed in 37 states. So I can cover most of the US with these.
What is your typical interest rate?
Assuming good credit and 20% down, I'm seeing high 6s, low 7s right now. So I have 4 going at 6.875, another one at 7.5. They're kind of in that range.
So the $50,000 house you're talking about, I'm going to assume it's not turnkey. So how does that play in? As far as figuring out are you going off like renovation?
No, that's a whole different loan program. So that's a fix and flip if we're going to do that. Those appraised. There are houses in Mobile. These you can get in $70,000, $80,000, which I think these came in at $76,000 is the number they came in at. So it's probably a $62,000 loan or something like that. But they're ready to go.
Okay.
Yeah, they're ready to go. What I tell people is if they're gonna hold the property and they can finance the repairs themselves, that's the cheapest way to do it, right? Do the loan, finance the repairs yourself, and then just keep going. You've got one set of closing costs. If you need a fix and flip loan, we can help, but then you end up with 2 sets of closing costs because you've got to buy the property and then refi out of that into your long-term loan. It's just more expensive. But it can be done.
And what is the closing cost for a 100K loan for DSCR?
Including everything, including first year's insurance, title costs, everything, $8,000 to $9,000. A lot of the costs just aren't a percent of the loan amount. They're set amounts. So it's like $8,000 to $9,000. Anybody else? All right. I appreciate your time.
Thank you, everybody.